You're about to join Jerry Parker, Moritz Seibert, and Niels Kaastrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Welcome to another edition of the Systematic Investor series, where each week we discuss and debate what is going on in the world of rule-based investing right now. My name is Niels Kaastrup-Larsen, and I'm excited to welcome my co-host Jerry Parker and Moritz Seibert for another interesting discussion, I hope. How are you guys?
Always good.
Very well, thank you. And you?
Yes, very well. Enjoying a little bit of autumn weather in Denmark this week, actually. So pretty nice. Obviously, a somewhat calmer week this week in the financial markets. Nevertheless, there could have been some interesting return drivers or changes in trends that we might want to just highlight and talk about. So I can kick it off this week for a change. So on our side, really, what we really saw was continued reduction in our equity exposure, partly from reducing long positions in the US, where it's really been the only long positions we've had for a while, but then also adding to short positions in Europe, which means overall our long positions are somewhat reduced and significantly reduced from what they were before the last wobble in the stock markets 10, 15 days or so ago. And some reductions in energy. I mean, obviously the markets have been correcting in the last also 10 days or so, and we see some gradual reductions on that side. Although other sectors have been pretty quiet, maybe fixed income, continued weakness in the US has allowed us to take on a little bit more risk on the short side in the fixed income side. What about you guys? What have you seen, noted from your systems and models this week?
Very uneventful on my side. Really, nothing much happened. Steady week back and forth in some of the markets, but no changes in positions, no reductions in size. So very, very quiet.
Okay. What about you, Jerry? Anything exciting going on in your diversified portfolio?
Not really. We had some reductions in the stocks and some new long positions. It seems that in the stocks, sometimes the recent worst performers can have a good week or a good day when the markets are weak. People are looking for bargains and shifting from tech to more boring names and ideas. So saw a little bit of that. Long Disney this week and continued weakness in some of the tech sector, but pretty quiet. I'm happy for quiet.
Yeah, in our business, sometimes quiet is often very good. No, that's fine. I mean, otherwise, I can add from our side really that in terms of return drivers, really, fixed income has been the biggest sector win overall this week, and then losses really showed up in things like energy, overall currencies, stocks, and other commodities, pretty quiet, maybe with the exception of coffee. Coffee seemed to be, heading north now, and short positions were hurting a little bit this week. But other than that, nothing much. Pretty focused on, or pretty concentrated, I should say, on the US fixed income, and overall a positive week all in all. So any interesting themes that you came across, or sort of news that we want to discuss? I know we have lots of questions, and of course we want to get to Jerry's tweets, but before we do that, any other things that you wanted to bring up before we discuss some of the tweets for this week?
Well, I was sort of hopeful that the 500-point rally would stick, and we've sort of had a little unwarranted sell-off, and now we're going to go back and we're going to reduce this volatility, and it's not going to get crazy anymore. But then the sell-off later in the week, and then the renewed increase in rates. So I think we're in the same situation. It could be rock and roll next week with the stock markets seeing lows, and we'll see what happens with the dollar. It's a big part of our portfolio. Hopefully that trend continues.
Yeah, no, absolutely. Why don't we just dive straight to your tweets? I know you were just mentioning before we started that you might have had the biggest response of all times to one of your tweets this week. So that sounds interesting, but we can take them in chronological order or whatever order you wish to bring them up today.
Yeah, so this one got a lot of responses, probably the most I've ever had. This really speaks to all the pain we all go through and how it really, what we have to deal with on a daily basis of just sort of waiting for our systems to kick in and do what we hope that they do. And maybe they'll preserve profit. Maybe we'll give it all back. We don't know. We're waiting and we're hoping. So it goes like this: the willingness to allow the current trade's P&L to be determined by the system's rules and not try to stop it, not try to stop the pain, is a necessary and rare quality. It's an illusion that discretionary moves can enhance performance. The current trade seems very important, but it's really not in the long run. We're in the moment, we're losing, clients are complaining, we've got to wait for this exit to hit. If we do this trade and follow this system, our experience has been that'll be a good thing. It may not work in this particular situation, but I'm in this situation, and I really feel anxious and pain that by following the system, this particular trade may not work out. But I am committed to all of the trades working out and understanding that over time, following my system religiously to an extreme way will produce the best results. But these results right now seem so important. And maybe if I just liquidated quicker, did a discretionary non-system trade move, I could actually help myself here. And it just sows the seeds for worse performance in the future. And it's an illusion because this trade is not that important. You know, maybe if it is, you're trading too large, or you're trading that market too large, or you have bad clients. I don't know, but stick with it. And this just resonated with people, and that I think that we all, we're helpless because the clients are like, do I really want a trader and a manager who is waiting on that dumb computer and just sitting there and cannot move until the system rule gets hit? And we're like, yeah, we kind of feel the same way, even though in the long run, we know that's the best approach. And I feel like that a lot of us feel like we're in this together, and we trying to encourage each other. And this was just an overwhelming response to something I just had like come out of my brain. It was one of the rare tweets where it wasn't a copy paste from someone's article.
Yeah, I mean, it's interesting, and it's so true. And I think you definitely hit a nerve with people, and it's interesting, right? Because we tell people, and because we believe in it, that having rules and having the ability to backtest, get comfortable, understand, what the parameters in terms of risk and reward will most likely look like. That's really why we part of why we embrace the systematic versus the discretionary, where you have no way of backtesting, you have no way of knowing. Yet having all that comfort from the past, as you rightly say, Jerry, it doesn't make it much easier in the moment, right? And it's so funny that these maybe it's just recency, maybe it's the fact that we focus so much on recent performance, even if we know better, so to speak. That bias within us is so strong. I don't know. I think it's absolutely true, and it's something that we have to continue to to discipline ourselves with, not to get emotionally involved. Any thoughts on your side, Moritz?
Well, I absolutely loved that tweet. I retweeted it and liked it. Has so much wisdom in it. I mean, the fact that, we know that the trades that we do, each of those trades has the same expectancy, and the current trade just isn't that important. It's only important because it's happening right now. It's not more important or unimportant than any of the trades we did in the past. And it's so easy to forget that, right? Because you live in the moment right now. You have that trade. Maybe you've sized it too large. That shouldn't happen, but that's one of the ways that a trade can become too important. But other than that, it's just one trade out of so many that we do that really, you shouldn't give it that much attention. So that's just great there. And also the fact that, yes, if you have a system, if you run that system, just go with it. Even a basic mediocre system, I believe, following that basic system is better than discretionary going back and forth in those noisy markets. So they will come with pain. And it's exactly at that point where you must not break. You must not break. Just continue following those rules, because if you change them right then and there, you've changed the system and you'll get something different going forward. And there's no longer any reliability in what you've tested for the past.
So how can we do a better job, or how can we help investors better to not focus on the recent performance? I mean, we've tried for decades to do this, and I don't think we're really succeeding to some extent. We see it succeeding with some, and I think the comments from last week where Jerry mentioned one of your clients just coming back to you, I think it was in February, saying, all I need to know is you're following your system and things like that. So clearly there are some people out there who fully understand, embrace, and understand the difficulty of sometimes following a system, but the importance of it as well. What else can we do?
I've really like the idea of showing clients charts. And here's a chart, and here's where we made the money. We got in here, we wrote it for a year or whatever. It's a really nice trend, and look how much money we made, and look how many opportunities we had in those 12 months or whatever to get out. It was painful drawdown here. This has happened in the current crude trade quite often, where there's been $3 or $4 drops over a period of a week or two, and these don't feel good. But you know what? A week or two later, after that, they don't feel anything. They're like, oh yeah, that's what I do. I stay in those. But in the moment, it was like, oh my gosh, is there system failure here? I'm losing so much money. It's down $4 or $5 from the high. That's not something I pay attention to. My system is a breakout or a moving average. I've got another $4 or $5 before I'm going to get out. Oh my gosh, this is horrible. So just putting into their head what we see, which is look at that chart, look to see what kind of toughness it took and what kind of system it took to maximize the profit on that trade. That's pretty much the one thing that I look at more than anything. Not sharp, not really return specifically, but give me the charts of the top 10 or 15 trades recently, and let's see how we did. Did we stay too long? Were we too bold? Were we too short term? And how did we maximize the profit? This process of maximizing the profit and the opportunities we have. We don't always have a lot of opportunities. The trends can go away for a while, but then how did I do with the opportunities I had? And you're going to be one of the things we all like to do is take profits quicker than the computer says and the backtest says we should.
Yeah. I think that's true. I think visualization of these things, because people, as we all know, a lot of investors still feel that what we do is a black box, and even though we feel it's far from it, I think visualization in that way makes sense, and hopefully should build confidence from investors to see that it did make sense what the system did, even though it was painful along the way. Yeah,
reminds me of the topic we talked about a few weeks ago, the 200-day moving average no longer works. And then in that article was a chart that showed the past few times the S&P has gone below the 200-day moving average, it was a good buy. And if you watch these markets long enough, that's exactly what you see, is that these price movements most of the time don't really mean too much. You could be limit up today and limit down tomorrow. And so follow the system, because most of the time it doesn't matter very much, it doesn't mean that the next time it goes below, it could be a really great place to get short. But there really isn't any reason to get too excited about good price action or bad price action, because more than likely it's going to be much different over the next few days. There was a follow-up to that, which was didn't get as much popularity, but I think from my point of view, CTA in business for a long time and doing research and backtesting and listening to how other traders describe their backtesting and their systems, I thought that this was one of my favorites, but not many other people. It was a follow-up to the one I just read, which is, however, these days we're much trickier. We program the algos to avoid the same pain. Quote, get me out before I lose too much money, unquote. We can claim to follow the rules, but the result can be the same. And I think that's what we're doing and are susceptible to these days. When I was a young trader starting out, I sat in front of a quote machine with a chart book, and I filled in the daily open, high, low, close with my pencil. And so I would sit there and get freaked out about a big coffee move or want to get out quicker or avoid a trade. And definitely no one would say that was legitimate. You're not following the system. But now I think we have the temptation and the ability to program in those same bad ideas to take small profits and somewhat have other features that prevent more of a traditional approach to just following breakouts or moving averages or price trends. And we can say, well, it's just part of my rules. And yet it kind of does the same thing that we used to have to do just when we didn't have fancy computers and people programmed them for us.
I think that's a great point, and it's very, very important. Actually, I remember just back in February when we had the big correction in equities, which was really, really painful for a lot of managers, including us. Even though it came at the back of a great period, but still it felt painful. And we had a lot of inquiries about people asking, so what are you going to change to avoid this in the future? And the answer was really, well, probably nothing, because we're not here to try and fit our systems to avoid a 3-day losing streak, however painful it is. If anything we look at over the long term would decrease in value just to avoid that kind of event, so to speak. And I think that goes, to your point, Jerry, that it's so easy, I guess, and it's also tempting to try and continue to come up with changes to your system to make it look smooth or smoother. I don't think trend follows will ever be smooth, but it could be smoother, and that's a really dangerous path to go down on if you don't fully understand the consequences. Because every time you change your system, however little, you run the risk of that change being quote unquote bad for your system. And so I know certainly on our side, I don't know about you guys, but on our side, we rarely changes, our model. It has to, it can take years before we make a meaningful change to it, because we really don't want to run that risk, so to speak.
Yeah, you certainly don't want to change it just in response to a 3-day downturn in the equities, right? It's just one of the things that we have to accept, period. And, sometimes I think, and I actually once did that exercise myself here on a spreadsheet, is if only investors looked at performance numbers less frequently, right? I mean, some of the funds, they report monthly numbers, but if you reduced that to, say, annual numbers, and you looked at CTA performance on an annual basis only, so there's one data point per year, right? Most of the volatility goes away. You don't see periods like the week before last, right? You don't feel the pain because it's no longer part of the data set. I know that's not what investors do. They want ideally to have even intraday prices, which I don't understand. But it's kind of like our job to take the pain on a daily basis. Investors take the pain on a daily basis if they opt in and say, I also want to have a look at that on a daily basis. But why do that? If you've committed to make that a long-term investment, just look at it every once in a while. And a lot of that pain, I think, would just go away. And it's also like, it's with the media, the same thing. You have the week before last and news come up saying trend following is no longer working. There you have it. It's down, I don't know, 4 or 5, 6% or whatever the fund's lost. And what does that mean? It's just 1 week, right? Completely besides the point.
Now, you're making me think about all the tweets I've done over the years about private equity. And there's lots of studies out there that says, private equity is just pretty highly correlated to owning small stocks.
Right.
And, but because it has some great features to it. And one of them is it doesn't report very often. There's no mark to market.
Yeah.
And so we can talk bad about it and say, oh, that's crazy. That's not good. We're held to a much higher standard. But I think not only do the managers like it, but the clients like it. I think the clients are sick and tired of having to print these reports and send them around to management and say, look how my stock traders or CTAs and hedge funds are doing. They report daily. I'm so happy that we have a lot of our portfolio in private equity and there's no change from yesterday. So I think that not only, the clients kind of prefer it. They're weak. They don't know. They can't trade. They just don't want to continue to deliver all this bad news. So I think that I'm in the mutual fund business with daily liquidity, for God's sakes. So don't listen to me. But I do think that having a CTA, where's the CTA out there who says we refuse to report? I refuse to tell you what's going on until the end of the year. I had another tweet. I can't remember it, but it was something. It's got a lot of love, which was 10-year money. 10-year money. I'll tell you, I'll give you your money back in 10 years. And this was Howard Marks, I believe. And he said, honestly, you're doing your clients a favor if you just lock it up for 10 years. And of course, everyone knows that, but it's hard to do.
And there's a couple of managers I've seen where they're starting to ask for a lockup, even in a space closer to the CTA space. And of course, we think initially, so why are they doing that? Are they going completely into illiquid stuff? But maybe the truth is that actually it's a much better product for everyone to do that. I was curious, Jerry, how do you balance innovation versus kind of change? I mean, clients want us to innovate, or investors want us to innovate. They don't necessarily want us to change. And as we talked about just before, we also don't want to, try and be too clever about what we look for in terms of research. How do you balance all of that on your side?
I'm baffled by the things I see and read from other managers about evolving, coming to mind some of the interviews you yourself have done recently.
Sure.
And there's a huge emphasis on evolving, and I just don't get it. I mean, I think that it's perfectly fine for that trend following underperforms for a long period. It's going to always underperform. There's nothing we can do about it, or that it stops working. I mean, these are perfectly acceptable explanations, but I don't understand using less data. Like, let's just focus on less data. I think that's sort of the definition of some of the types of evolving I've heard of. If the markets are changing and environments are changing and fundamentals are always changing, then what else could it be other than, well, we just got to look at less data. And that to me does not ring true. That goes at the heart. That's putting a stake in the heart of trend following, where we rely upon large sample sizes and doing backtest over many, many years, different environments and different economic inflation and no inflation. And then we say, oh, forget that. The markets have changed. Less data, and we'll overweight their most recent data or something. So I'm a little baffled by it. I'm always making sort of improvements more from an understanding point of view. I fundamentally got something wrong and didn't handle the money management correctly. But when you look at all the data, like we like to do, all of the data, the chances that you're going to change a parameter or have a tremendous insight to have a material change, I think it gets less and less every day, because you're just adding the more data you have, the less I can really change. I think the CTAs, at least the way I trade, when the markets fundamentally change and what we do doesn't work, I'll probably be the last one to know, because the first 20 or 30 years of my data set, what we did was wonderful. It's great. And I believe it will come back and continue to be wonderful. But I'm really baffled by how one can evolve without making the system less robust.
Yeah, I think I think that's another interesting conversation, because I think with this wave of AI and machine learning that's coming, into our industry at the moment in these years, and which I'm sure will continue to flood the headlines of some sort, we're going to clash with that in some ways. I mean, some managers have started to adopt this. I don't know how successful, frankly, that they have been in adopting AI into trend following. But I think in the investor's mind, they're going to be making the argument that, well, we can now do machine learning, and with AI, we can analyze even more stuff and so on and so forth. And so it's this constant battle between constant change and learning versus sticking to something that has been robust, which is not particularly optimized in any way, shape, or form, but doesn't look, it's not the perfect equity curve for sure, but it does work over time. So I think I actually probably think it'll grow even further in terms of the debate about what is the best approach. So yeah, it's interesting. Any other good tweets this week? We seem to be on a roll here, Jerry.
Yes, once again, Howard Marks, not a trend follower. I don't think he likes looking at prices only and following trends, but he had an interview this week, and it's a lot of deep, good wisdom, and on a philosophical level, somehow I feel a kindred spirit to some of the things he says. And, one of my goals is to listen to traditional non-trend following people and interpret it in my own way as it relates, and see it through the lens of trend following. So his tweet was, or his quote was, in order to get an above average return in the long run, you have to buy things for less than they're worth. Which is to say that other people out there have to be selling that thing for less than it's worth. And so this is not an original thought of mine. I have other smart friends who mentioned this to me years ago, something along the lines of, given that trend following has been profitable, it has a positive expectation. Buying the upside breakout must be buying things for less than they're worth. For 35 years, I've been taking advantage of that mistake. # anchoring. So I think buying the highs, whatever that means, the 50-day high, the 100-day high, getting long at a breakout level or a moving average crossover, by definition, it's not the lowest price you've seen recently. And it doesn't sound very like a bargain. Why? Maybe I need a system that could have bought way before that. And although I think what I'm trying to say is your brain is anchoring that to that low of that chart, or the recent lows, and how much fun it would have been to get long there. But that doesn't mean that the upside breakout isn't still buying something for less than it's worth. I think by definition it is. So don't feel bad about that. Just remind ourselves that we are buying bargains. In hindsight, when we have a good trend, where we got in was a really, really fun place to get in, really perfect place to get in. And the embedded risk control of waiting for a high versus trying to buy the low, there's all sorts of advantages in that too.
Yeah. I mean, I know we were talking about something before we started recording today, and it goes to this point about, how people see something that's undervalued, or maybe they miss seeing something that's undervalued, and they tend to focus on things that actually are probably overvalued. And I used this example where I came across an interview with Michael Lewis, the well-known author, and he was actually talking about his more recent books, but he had to go back to the book called Moneyball to explain sort of the whole crux of the matter and how he came to write a book about Daniel Kahneman and Amos Tversky. And it went back to, I think, the first time he came into the locker room of the Oakland A's, and he was watching the players come out from the shower with very little clothes on, and he was looking at these people, and they, people were overweight, and some had, some disfigured function, on their bodies, and then one had 2 club feet, and they certainly weren't the perfect athletes when you saw them. And he was making this argument to the management of the Oakland A's, saying, well, if we line up all your players up against a wall wearing very little clothes, then you are someone, what do these people do? Nobody would guess that these are professional athletes. And the answer was really, well, that's the point. Because what they were looking for were not the best looking players. They were not looking for people who essentially looked good. I mean, they actually go on to the example of saying people or players who look good, visually look good, they tend to be overvalued. Whilst people who didn't really look like a football player, even though they had a very important role and value, would typically be undervalued. And I think it's a little bit the same, just in a completely different way, of course. And that is that we tend to look at things that looks good when we, for example, analyze investment strategies, while things that is less attractive, certainly trend following would fall into that camp, is often overlooked or dismissed. And the same with entry points and exit points. We the perfect entry point, yeah, sure, but how many people really can identify the perfect entry point, right? So, so it's an interesting discussion. Anything on your side, Moritz, or should we try and tackle some questions for this week?
Yeah, not too much. I mean, I know it's we're buying those points, we're buying those highs, and hopefully later on they prove to be great entry points and bargains. And at the time we entered the trade, visually they haven't looked like that. And just one thing comes to mind there. I remember being asked, looking at a chart, and the chart has been in an uptrend, and the question was kind of like, what would you do? Would you, at that point, so the most recent data point, would you buy or sell? And then, the thing has been going up. I was like, well, neither. I just stay long. And the person looked at me like, well, that wasn't my question. You're not answering my question. Would you buy that or sell that? I probably bought that a month ago because it's been going up. That's just what we do. Those entries, they they don't look always that rational on a chart, but we take them.
Sure. Well, we have lots of questions, so I'm going to try and get to as many as we possibly can today. So apologize to those of you who have sent in questions where we don't get to it this week, but we are going to tackle some questions from George that came through Twitter. And so there are several of them. So let's just jump in. Question number 1 is talk about optimization in general? I'm going to add a few more of these questions to put a little bit of color on it, and maybe you can then talk to that. Do you backtest portfolios in aggregate or as parts, and then you combine it? If you test things as an aggregate portfolio, offense levels, maybe that's a typo, but levels of optimizations become basically unsolvable due to too many permutations. What do you do? Anyways, something about optimization and backtesting. Who wants to jump in on this? Maybe you, Jerry.
Well, we test each market individually using the same system and parameters. And then we combine those results and see what we have. We use the same money management, so we sort of know what probably is going to work with the range and how we want to do things. So really the great thing about trend following is that a whole group of parameters will work pretty well. They'll have different performance over a year or two, but most of the systems that we use, which is just pretty much the same way of trading, but with different parameters, they make about the same amount of money, over a 15, 20-year period. So I don't really see any benefit in optimizing. Really what we try to do is say, okay, let's check out these parameters and try to come up with the shortest term we want to trade. And then we check out some more and we say, okay, this is probably the longest term we want to trade. And then we may just trade everything in between. And without regard to actual performance we're not going to pay too much attention to the performance, and thus we're not going to really feel the need to optimize too much. The critical thing is we're going to add all those trades together. We're going to look at those stats, the trade stats, average win, average loss, winning percentage. Take a look at the theoretical, hypothetical performance on a monthly basis, let's say, but we're going to treat those trades as if it's just all the same markets and not look at the shorts differently from the longs. It's all just one group of trades. Not look at grains different from currencies. It's all one group of trades, as if it's just all the same market. And we're going to say, okay, this system has an average expectation of X and win percentage of Y, and we're happy. And it handles, once again, how does it handle the big moves? I think overlaying your system on top of a Bitcoin chart, that's pretty brutal chart. A lot of profit there. How are you going to stay in that trade till it peaks, and then how are you going to get out of there with some reasonable profit? So I think analyzing tough charts, tough markets, tough moves, it'll tell you a lot about your system.
Yeah. What about you, Moritz?
Just like Jerry, of course, we look at, different parameter sets. Like Jerry, I'm, looking at each market individually, but treating all the markets in the same way, treating the longs and the shorts in the same way. That's important. So I don't want to, specify specific parameters just for certain markets. That's not a good recipe for success. But obviously looking at like different trend speeds, and you will see that, certain speeds or time frames, they work better on some markets than on others. There comes the point though where you have to make a decision, right? How short term do you want to be? How much trading cost does that involve? How long term do you want to be? Maybe that's larger drawdowns, but larger profits at the end of the day, over the long term. Those are decisions you have to make. And, look at parameter sensitivity. There's always, that sweet spot that you can find where you say, well, if it's like the 114-day breakout, well, I'm not saying that's the number, but that's the best, right? Well, maybe that's not the one you want to take. Maybe you want to find an area where things have, on average, worked reasonably well, and then just be fine with that. Apply to the overall portfolio, use the same money management, risk management rules across all the markets and the portfolio. And then I focus a lot of my time on adding diversification to the portfolio. Diversification can be added through new markets, different markets, but again, trading them the same way, just, having different bets on because they react differently at different points in time. And system diversification, right? So Like Jerry said, I mean, you'll find trend following systems that over a 15, 20, 25 year period produce about the same amount of money, but to get from point A to point B, they take a slightly different path. So you can get some diversification by, combining different methods into one portfolio. But again, none of those is highly over-engineered, over-optimized for anything and they don't even have that many parameters. Any of those additional parameters that I add, like here's another profit target, here's another early exit, here's another this or that will smooth my historical equity curve and increase the Sharpe ratio, make things better. But that will only work in the rearview mirror. And that data set that, we've looked at in the past and that we've used to optimize the system is so unlikely to occur again in the future that it just, it looks good in the past, but there's just no expectancy for that in the future.
Sure. So we probably do something similar, yet a little bit different. So of course we also trade, all markets the same way. We treat them individually and so on and so forth. But we do something different, or we have done in the last 12 years, and that is we essentially look at many different combinations of parameters. Hundreds of combinations of parameters, and then we have an automatic selection process. In the old days, when we first started doing this, we could simply only run it once a month because it took so long to compute. But nowadays, we actually do it every week. It allows us to, and very often there will be no change in the lineup, so to speak, because we want to select a subset of all of these parameter combinations that we quote unquote think are the best based on certain rules. So all of this is systematic, it's automated, and I don't think necessarily that performance changes a lot whether you did this on an annual basis or quarterly basis or weekly basis, but it does allow us to make only very small adjustments when we do see a change in parameter combinations, which helps us not to show any footprint in the markets from a trading point of view, but it also allows the model to evolve over time, or to recalibrate, I would say, because it's not changing, it's not a different model, it's just recalibrating itself. And so what we may see, for example, is that the time horizon of our look back period could shift from, say, more medium term at times to more longer term at times, and so on and so forth. So just a different way to approach that point. I think a lot of this goes mostly, to some extent at least, mostly towards sort of entry points and so on and so forth. And actually, it's my belief that the least important thing we do is probably the entry. I think the exits and the risk management are more important. But so we do it differently to answer your question, George, about these things. But in general, it's the same philosophy about treating all markets equal, being fully diversified, etc., etc. So great questions. Appreciate that. George had a few extra questions that I will try to right. So the next question he has is, how do you determine when a model is broken? Do you fix broken parts of the model or just the whole? If a backtest includes markets that don't make money over the life, do you re-optimize those markets or let them ride? ? I think we've touched a little bit upon this, but maybe you want to deal with the question about the model being broken and how do we fix that? Do you want to start on this one, Moritz or Jerry?
The second question is much easier. We just, it's inevitable that you're going to have some, once you've done your testing and your research, you're happy with your system, it makes good money, and you're going to have a couple markets in there that underperform, lose money, and then some that are amazingly great. So you don't do anything with either of those. You size, weight those markets on the portfolio. We pay no attention to historical performance. Let's say wheat is not a good performer, cocoa, bean oil, They're great because they add diversification. So they get an equal weighting with the yen and the crude that are probably the best money makers, let's say, and some stock out there, of course. But they get a weighting that's based upon their contribution to the portfolio based on correlation only. All trades make the same amount of money. Well, wait a second. Wheat lost money. Okay, that's another show. We'll get into that. But trust me, they all make. We need to assume that their expectation for every trade is the same. When a system is broken, I think that's a tough question. Trend following looks broken because there's no trends now. Okay, so my system, though, let's say we have a good trend period, and I still think that it's broken, and I'm too short term, I'm too long term. That's where I'd start looking and asking questions. I got out too quickly. I had a big profit, and I gave back too much profit. I don't have the Bitcoin. How did I do in a choppy market? I'm going to do well. I'm going to do really well in a choppy uptrend, crude, heating oil, because I am longer term. I'm not getting shaken out. Market goes back to the highs. I didn't get out. A parabolic trade like Bitcoin and some of the amazing monster trends, I didn't even need to be long term because it was like straight up. Then, okay, how are you going to get out of that trade when it finally does turn around and not give back all your profits very quickly as it sort of crashes? I think that's a problem these days, is the crashing in the stocks and in all the markets. So how am I handling these individual trades where there's a lot of profit opportunity? Maybe that's what I'm looking at first rather than looking at the back test maybe.
Mm-hmm. Yeah, no, I think that's an important point also to reiterate, is this thing about, yes, you can have markets that actually have not produced a profit for years, yet they can still play an important role in the portfolio. I seem to remember, if I was looking at performance attribution, say a couple of years ago, and looking back in time, I don't think we had made a lot of money in equities, leading into 2017. Yet since 2017, it's all equities to a large extent. So you want to be careful with, and I completely agree, that's certainly something we found on our side as well. And that is, in the very long run, whether it's 20, 30 or 40 years, doesn't really matter, but it's the very long run. We believe all markets will be able to produce the same level of performance. We see no reason why that should not be the case. Yeah. Anything you want to add on your side, Moritz?
Yeah, sure. What I do is just I sit back, look at the markets, and ask myself, is the system doing what it's supposed to do given that market environment? And if there are no trends, we're trading a trend following system, we're not expecting to be making money. So the system is exactly doing what it's supposed to do. And so that is a question that I ask myself all the time, like, did something change? Is this now behaving in a different way than I'm expecting it to behave? And the answer is thus far no. And then also, I want to be objective about the time periods here. I mean, even if, we have, 3 years in a row where performance hasn't been as good as it has been in the past, if I can test a system for 30 years and I have a 30-year record on that, then 3 years, that's like 10% of that sample size. And just, statistically speaking, at 10%, I mean, this is just not large enough a set or a quantity to arrive at any conclusion and say it's broken. So, I think we're coming back to that point of, how frequently do you observe those type of things, and how long does the pain last? It may last, 4 or 5 years. And I still wouldn't say the system is broken because it's not yet enough data to jump to that conclusion. Of course, I'm following, what I read. I mean, is how much money is there in trend following? Are we all trying to hit on the same thing? Is that having an impact? Well, I don't know that. I don't have a 100% firm opinion on that at that point. But, those are the type of things that I'm mindful of and I'm looking out for. And I think that's the most important thing for me.
Sure. No, absolutely. Now, George had a third tweet with the final questions. I think some of these questions, by the way, we've already hit on. So maybe we just want to hit on the ones that you feel we have not already discussed. But he goes on to ask, do you do market level optimization? How do you avoid curve fitting? At some level, all systematic becomes discretionary. How do you choose the best parameters? Best backtest result, most logical, so to speak. Any final thoughts on these type of questions? I think we already talked about parameters, earlier on.
Yeah, I think there. Obviously, there's a little bit of preference, personal preference on what is important to you. Sharp, I think, is important to a lot of people. I've already said I like average win, average loss, the ratio of average win divided by average loss, percentage of winning trades. I don't want to pay too much attention to the theoretical back test, the theoretical equity curve. How frequently am I going to make money? My 12-month rolling rate of return, so I think that's where a lot of it comes in, and I'll choose different parameters or different ways of trading than other people. And so I think maybe that's what he's asking, and I think that's fine. And so it's at some level there will be, once we look at the analysis, the runs and the systems, we have to make a decision. How are we going to do things? So I guess there is a little bit of discretion in there, and but I don't think it's bothersome. It's obvious.
Sure. No, I agree. I mean, there is obviously subjectivity in the research process, but once it's past the research process, at least on our side, there's no further subjectivity or discretion. It's all rule-based. And that's also why we decided to automate the parameter selection, so there was no, quarterly or annual meeting saying, oh, we need to allocate a little bit more to this time frame or to this time frame. I mean, we wanted to avoid that, but it doesn't mean that that's the right way to do it. It's just our way of doing it, for sure. Any final thoughts on this question from you, Moritz? Well,
we are active, systematic managers, right? I mean, you design a system that is your preference, that's your choice. You set the rules in stone, you run with it. Now, like I think said in another episode already, there may be points where you decide to make changes to those rules, maybe minor changes, maybe changes in the money management rules, maybe you're adding more markets. That is all the active part of that, right? It's not passive buy and hold. You always do the same thing for the rest of your life. That's not what it is. But the rules may change ever so slightly. It doesn't impact or affect the character that there's still a trend following model that's highly diversified across many different markets that we trade. That's always going to be there. And when we have the rules and they're ready to go, I'll just go with them.
Absolutely.
I really like your idea, Niels. I think that's perfect. I don't know if I would agree with it the way it's executed, or I'd have to just know more specifically. But I really think it's a great goal for everyone, is to put this systematic approach in place with an eye towards, not to really have to offer too much discretion and emotion for the next 100 years. How could I possibly even have in a good, robust, scientific way, have the computer choose my parameters? And I think this is a very, very good, interesting idea, and I like it. I don't do it. It's work. I mean, sometimes it's more work to program things than it is just to do it by hand, but I admire that, and I think it's a really good mindset that we're going to be so systematic that even when we make changes, we're going to do as little as we can ourselves and be committed to more of a scientific process.
Maybe that's what machine learning and AI are going to do at some point.
Well, in a sense, we machine learning is nothing new, right? We've had it. It's just becoming maybe more popular and more advanced with, the changes to what computers can do. But the idea of choosing certain things within trend following, and also because trend following is generally a slow moving, strategy, it's certainly doable. This was, it's funny because we've made 3 major changes in the last 12 years or so. And this was the first one. So this goes back to 2006, having automation in our parameter selection. So it's actually nothing new in that sense. But maybe, as Jerry says, maybe more and more people will go down that route as well. Well, anyway, George, thanks so much for all your insightful questions. We appreciate it. And I know there are more. There are, among others, questions from Paul, whom I know and came in to me just a couple of days ago. But I will defer those questions, Paul, to next week. Sorry about that. But we are approaching the hour mark, and we certainly want to respect your time and not take up too much of your weekend or whenever you're listening to this. I also just want to run down some of the performance numbers, as we always do. And these are numbers as of Thursday night, so the 18th of October, and I'm not so sure how much really happened on Friday, so maybe they're not that different. So the BTOP 50 index is down 2.9% in October, down 5.4% for the year. SocGen CTA is down 3.58% for the month, down 6.92% for the year. The SocGen Trend Index is down 5.37% for the month, and down 8.38 for the year. And finally, the SocGen Short-Term Traders Index is down about 10 basis points for the month, up 0.28 for the year. And the Bridge Alternatives Index, which is a flat fee index index of flat fee funds, down 3.92 for the month and down 9.46 for the year. Any final thoughts, ideas, suggestions, anything you can come up with that we should leave our listeners with before we wrap up this week's conversation?
Happy trading.
Happy trading, as always. Happy trading. Yes, that's right. Anything on your side, Jerry, springs to mind?
I'll keep the questions coming, and direct message on Twitter. And thanks for your patience, George, hanging in there. And we want to be responsive, and we want to be there and be encouragement for everyone.
Absolutely. And I think a lot of, I sensed right now that a lot of the questions are coming from people who are on the same side as we are of the business, so sort of the manager side. But I certainly would encourage people who are on the investor side to also put forward questions to us. We certainly can't think of, and we don't think of all the important issues that you may also want to debate. So in order for us to include that in our conversations, we really do appreciate and encourage all of these things coming in. So anyway, on that note, let's wrap up this week's conversation. We hope that you have enjoyed it just as much as we enjoy making them for you. And if you felt you got something out of it, please share, and why not leave us a rating and review on iTunes? It really does help. So from Jerry, Moritz, and me, thank you so much for listening, and we look forward to being back with you next week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.